Hello everyone, and welcome back to the channel where we dive deep into the fascinating world of short squeezes and hard-to-borrow stocks. Today, we're putting a unique spotlight on a microcap that has recently appeared on our screeners due to an astonishing cost-to-borrow fee, TGHL. We're going to dissect what makes TGHL an intriguing case study right now. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show TGHL logo/ticker. TGHL is a microcap company, meaning it has a relatively small market capitalization. As we look at the data, it's clear why it's on our radar. Our internal composite squeeze score for TGHL currently sits at 46.5 out of 100. This isn't the highest score we've ever seen, but it certainly indicates some underlying conditions worth exploring, particularly its hard-to-borrow status. What is cost to borrow and why it matters? So, what does it mean when a stock is hard to borrow? In simple terms, for a short seller to bet against a company, they first need to borrow shares. The cost to borrow, or CTB, is the annualized interest rate short sellers pay to borrow those shares. Think of it like a rental fee. When a stock is hard to borrow, it means there are very few shares available for lending, and the demand to short them is pushing that rental fee incredibly high. A CTB fee can exceed 100% annualized, sometimes even reaching hundreds or thousands of %, which tells you just how scarce those shares are and how expensive it is to maintain a short position. Why this stock is hard to borrow right now. Now, let's look at TGHL specifically. Highlight CTB. The annualized cost to borrow fee for TGHL currently stands at an astounding 773.1%. That is an extremely high number, suggesting that shares of TGHL are indeed exceptionally difficult and expensive to borrow for shorting. Our data indicates an estimated float of 12.7 million shares, but the number of shares currently available to borrow is unknown, further reinforcing the idea of extreme scarcity. While we don't have CTB momentum data, the sheer level of the fee is a significant signal in itself. Squeeze mechanics explained. This high cost to borrow is a critical component of what can lead to a short squeeze. Imagine short sellers are paying over 773% interest just to hold their positions. If the stock price starts to rise, even modestly, these short sellers face a double whammy: losses on their short positions and incredibly high daily fees just to stay in the trade. If a significant number of short sellers decide to cut their losses or can no longer afford the fees, they are forced to cover their shorts. Covering a short means buying back the shares they initially borrowed, returning them to the lender. This forced buying creates demand for the stock, driving the price up further, which can trigger more short sellers to cover, creating a cascading effect. This is the essence of a short squeeze. Dilution risk check. Before getting too excited, it's crucial to consider dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This influx of new shares can dilute the value of existing shares and provide an easy supply for short sellers to cover their positions, effectively killing a short squeeze thesis. We performed a thorough check for TGHL and found no recent diluted SEC filings like SMIN-S1, SMIN-S3, or 424B within the last 90 days. We also found no recent reverse splits for TGHL in our look-back window. This is generally a positive sign, that it removes one potential obstacle to a squeeze. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Here's where things get interesting and a bit unique for TGHL. While the cost to borrow is exceptionally high, indicating extreme difficulty in shorting, the recent price and volume data tells another story. Today's change for TGHL is 0.0%. Over the last 5 days and 30 days, the change is also 0.0%. More critically, today's volume is 0 shares, and the 30-day average volume is also 0 shares, resulting in a relative volume of 0x average. This means that despite the astronomical cost to borrow, there's been no recent trading activity. This situation is rare and highlights that a high cost to borrow alone does not guarantee a squeeze. It could mean short sellers have extremely strong conviction and are willing to pay these high fees, or it could simply mean there's virtually no trading interest at all right now, making any short positions theoretical or extremely small. For TGHL to become an active short squeeze play, we would need to see a significant pickup in volume and price action. A squeeze cannot happen if there's no trading activity to force short covering. In summary, TGHL presents a peculiar case study with an incredibly high cost to borrow of 773.1% and no recent dilution risk. However, the current lack of trading volume and price action means that while the conditions for short squeeze mechanics are technically in place due to the borrow cost, the catalyst of actual market activity is missing. It's a stop to watch, but it would require a significant shift in trading volume to activate any potential squeeze. Keep an eye on TGHL for any signs of renewed interest and trading volume. If you found this breakdown insightful, please hit that like button, subscribe for more in-depth analyses, and let us know in the comments if there are other hard-to-borrow stocks you'd like us to cover.